Today, more insights from the consumer frontline. Hello again, it's Martin North from Digital Finance Analytics. Welcome to this post covering finance and problem news with a distinctively Australian flavour. Today, I'm joined by Steve from Canstar. Hi, Steve.
Hi, Martin. How are you?
Yeah, pretty good. How are you going?
I'm terrific, thank you.
You're in the right state at the moment in Queensland. We're still locked down here, so...
Yeah, we've got the big donut, 0 cases, which is was a pretty nice feeling. But of course, it doesn't help the economy that much when New South Wales and Victoria are shut down.
No, absolutely. Now, you've done some more research at Canstar, and it's pretty interesting and actually quite concerning stuff.
Yeah, it is. This is about people deferring and delaying financial decisions because of lockdowns. And 58% of people say they haven't, but 42% of people say they have. And they've had to make changes. And it's how they're making the changes they're making. Some of them are quite disturbing because they're the essentials of living. You know, they're deferring insurance renewals, paying bills, medical procedures, those style of things, even doing their tax. And those are things that can get you into a much deeper hole than the one you're in currently. And people are deferring those, so that's desperation.
Yeah, and I think it's important because it's coming through in my surveys too and in other people's that consumer confidence is definitely on the waiver. Business confidence, especially small business confidence, also particularly concerning at the moment. And as you say, unfortunately, people sometimes make the wrong decisions in what they do and what they don't do, and it can hit them down the track, unfortunately.
Yeah, it can. I mean, think about what it does to your credit rating if you don't pay your power bill, for example. Think of what it does if you don't pay an insurance and you have an event. You know, those financial decisions can be diabolical to your future situation, and you really don't want to do that. And it's quite disturbing that those decisions are being made by people, and they're being made because they're desperate. Their work's down, and the JobKeeper isn't as broad-based as it was. So we're seeing a lot of people in that sort of pain.
Yes, and it is different this time. So last year, JobKeeper and the other support programs were very, very powerful in terms of keeping people attached to their employers and those sorts of things. Not so much this time. It depends on how you calculate it, but probably the total support measures of state and federal are about 15% of what they were last year.
Yeah, that's right. And of course, you've got to be directly impacted. So in other words, you've really got to be losing your job or half of your job before you get paid this time around. Whereas the prior rule was, does it look like the business you work for is going to be down on their revenue? So of course, Australia-wide, people were receiving JobKeeper, businesses were receiving JobKeeper to keep people employed. And now it's actually people who've lost a job or lost half their job that are those eligible. Others aren't. So it's nowhere near the stimulus and nowhere near compensating those businesses and those employees who are being indirectly impacted.
And also, of course, the banks who are willing to help people with financial pressure on their mortgages, they seem to be a bit more cautious and coy this time as well. So whereas last time a lot of people were just given help whether they need it or not, again, you have to really ask and go through quite a lot of stress and questions to be able to get it.
Yeah, it's not automatic the way it was during the first COVID shutdown, and I understand why. But but I mean, banks have always been in that. They've always been prepared to listen to people and prepared to defer in certain scenarios. But now it's not automatic. You've got to prove up that you're in that scenario, and of course they'll look at your situation a little bit more. I guess maybe with a bit more rigor than they did during JobKeeper, and say, well, look, are you in a hole that's just too deep? And do you have to actually get out of that hole now and just take a hard decision? Now, they don't want to do that because it's bad for their business and it's bad for you personally. But they might end up having to make some of those calls because, this is the second lockdown and you defer so far and then you get to the point where affordability ongoing is going to be a problem.
No, well, I see that in my survey. So mortgage stress is higher than it's ever been in my surveys. And obviously a lot of it's down the East Coast and Victoria and New South Wales, although other states are also being impacted in sort of second-order terms in terms of the economic momentum that's much weaker than it was. And what I'm seeing is a lot of people drained their resources the first time around and managed to get through, and now they've got this other wave, and again, they're now in much more strife this time because they don't have the same resources to start with. So the chances are of them getting out without significant impact is actually quite a lot lower. So no wonder then why people are now sort of pulling back on some of those spending decisions and trying to hunker down. It's a natural reaction.
It is, and I think last time what really, I think, papered over some of the cracks, frankly, was the early release of superannuation. And, some people took out 20,000, some, who knows, whatever. I think some cleaned it out altogether, some younger folks perhaps. And we saw that in the credit card stats. When that was around, that early release of superannuation, the credit cards outstandings, the debt-paying interest outstandings tumbled. And, $4 or $5 billion was knocked off that bill, down to around 20, and then it went flat as soon as that stopped. So I think what we saw was some of those problems being really papered over in the first set of lockdowns, and we don't have that this time around, of course. So that bit of safety net's not there, and I can't see the government bringing that back because we'll do too much long-term damage to people's retirement.
Yes, well, I think that's exactly right. And some of those super drawdowns went into deposits on houses, I noticed in my surveys, which wasn't necessarily perhaps what was officially intended. But it is worth, reflecting on the amount of stimulus. Now, $3 billion was thrown into the home builder programs the first time around, plus all of that into, the other support programs. So there's a lot of money sloshing around, much less now. And of course, the Reserve Bank, in their comments this week, basically said, well, yeah, next quarter is going to be a problem, but the December quarter and into next year, we should bounce back very firmly. And they're talking at growth rates as 6 or 7%. I guess the question is, how confident are they and how confident should we be of what they're saying with regard to the recovery? Because if it is V-shaped again, we might get this sorted out. But I think there are some questions in my mind about how optimistic they are and whether they're a bit over-optimistic.
Yeah. I hope they're right, Martin. I think though I think the whole premise is that when the nation gets to 80% vaccination, that we will open up, and it will be business as usual, but business as usual on a bit of steroids, with a similar recovery in the property market to the one we saw out of the last, the major lockdown in 2020. I'm worried that we might not quite see that opening of even domestic borders quite so fast, because I suspect that there will still be lots and lots of cases in New South Wales and maybe Victoria too, fewer in the West, Queensland, South Australia. And I can imagine those states being a little reluctant to actually open up borders. And until you really open the borders fully, it's going to be hard to get that real bounce that the RBA is talking about.
Yes, I tend to agree with that. And of course, the other issue, international borders and migration, because migration, of course, is net negative slightly at the moment. And if you think of the property market and what drove that, one of the elements was migration, which was actually quite significant. That's gone away now. And we also know, of course, that quite a few people have been refinancing down to lower rates, as we've discussed before, the apathy tax. So there's a bit of that going on. But you can't keep doing that, right? You can't keep refinancing down, because once you're on the best rate you can get, you're on the best rate you can get. So in the round, I tend to think that there may be a longer drag this time through the cycle, rather than actually everything bouncing back as quickly as the RBA says. I hope they're right and I'm wrong, but I'm a little bit concerned that perhaps they've been a little bit too bullish this time.
Yeah, and when you look at the makeup of our economy, the number 2 and number 3 categories in the contributors to GDP are tourism and education, so overseas students coming into the country. Neither of those has started up again. When you look at our envious record prior to COVID, of no recession for, gosh, I forget how many years, but a lot of years, it was frankly supported by migration. And, increasing population meant greater wealth, meant GDP growth. And we haven't had any of that, any of those three things, migration, overseas students, tourism, for 2 years effectively. So, I just can't see that without the level of stimulus that we had coming out last time, that we can possibly expect the same sort of recovery that we got last time.
Yeah, I think that's probably right. And interestingly, of course, in the UK, where they're slightly ahead of us in terms of the pulling out, they've announced tax increases to try and help cover some of the costs of all the stimulus. Right now, it's dressed up as supporting the health service, etc., but it is a tax hike. And that's something else I think people need to think about, right? The chances are, down the track, once we get over the hump, as it were, not only might growth be a little bit slower than we actually think it currently might be projected by the RBA, but also I'm worrying about where are they going to make up the deficit, because they've got to at some point.
Yeah, they do. Australia's lucky that we came into this with a lot less debt than most countries. And, the proportion of debt to GDP in Australia is way below the UK and the US and most countries around the world. But we will eventually have to pay it. I hope that we wouldn't do anything that sounds as silly as a tax increase in the next 12 months, because there's too much pain around and too much mortgage stress, as you pointed out, for people to really absorb a tax decrease as well. And we haven't had any real wage growth now for years. And, we're just marking time with a very, very low inflation rate. So, I just don't think the community can afford a tax increase right now. I suspect they'll look for more creative ways of taxing certain segments, not a broad-based tax increase.
No, and possibly even more stimulus to try and encourage more people to go and buy those homeland packages. But that's a whole nother story. Last question, just in terms of mortgage rates, rates haven't really started lifting much more than when we touched on this last time around, insofar that now the expectation is that the Reserve Bank will not necessarily be lifting rates anytime soon, and the money markets seem to be signalling lower rates for longer. Is that what you're saying?
Yeah, we are. There's a little more detail to it, I guess, because we're still seeing 4 and 5 year fixed rates going up, not at the same pace as prior to this. 9 lenders put fixed rates up, and they're basically 4 and 5 year rates. But shorter term rates have continued to go down, and variable rates have gone down. So now we've got 163 fixed rates below 2% and 45 variable rates below 2%. Now, I think when you see there's a slight move towards competing harder on variable now, and you see that when the banks are thinking, look, rates may well start going up a little sooner than we thought because of whatever, and they don't want to lock themselves in with too much on the fixed book. So, I think we're seeing the start of that, but it's only the start. And look, just something else you mentioned earlier, and I meant to say, you said there's only so much you can do in terms of refinance. That's true, but it's true also that we're doing double the refinance in Australia that we were doing 12 months ago, but it's still a drop in the bucket of the total loans outstanding. And too many people are sitting back saying, look, I'm only paying 3.2%, 3.4%. It's the best I've ever had. It's not good enough right now when you look at those 200 plus loans that are below 2%. Don't give that away now. Get it locked away at a low rate or put it into a low variable rate and keep your repayments running so that you get ahead. Because if you do face higher taxes in 2 years' time, at least you'll build up your own little buffer.
Yeah, and we can't underscore this enough, right? That a lot of people are still sitting on rates that are way higher than they could get if they actually just took the initiative and went and did some searching on Canstar and wherever to get some information on rates. It's simple to do, and those savings are substantial. which means you can pay down more now if you're actually on a lower interest rate. But also, they run into the future as well. So effectively, it is a cumulative, huge benefit. And going right back to where you came in, which is to say a lot of people are, not making good decisions at the moment. This is one decision that you should be making. You should be doing the work. And frankly, every 6 months or every year, you should be checking to see whether your rate is the best you can get, because it makes such a huge difference.
The difference is massive. If you go from the average rate, which is about 3.28 or something, down to the lowest rate in the market for an 80% LVR loan, on a $500,000 loan, it's something like $300 or $400 a month difference. Now, you can keep that $300 or $400 going and you'll get well ahead with your loan, or you can put it into renewing that insurance policy that you might have deferred. You can't afford to gift that to your lender.
Oh, do you mean you can't help to support their profits? You should be looking after your own finances? Well, that's a very important thought. I agree. I've been saying this for quite some time, that, of course, the banks made huge profits in the last quarter, they reported, thanks, of course, to term funding facilities and everything else, but also because of this apathy, right? And there are thousands and thousands of people who should be doing something about their mortgage, getting those rates down, give you money at the bank, money in your pocket, money you can spend, and as you say, to deal with some of those other issues. So we know, very important message that I want to keep plugging, and I know you keep plugging too, because it's probably the most important message out there at the moment. A mortgage is the biggest commitment, financial commitment that you have, and yet so many people don't take the time and the initiative just to check to make sure that you've got the very best rate. So folks, time to do it.
It's always the time to do it, but now more than ever. And if you're struggling, if you're one of those 42%, you will not save $400, $500, $600 per month, whatever, depending on how big your mortgage is. You will not save that on the grocery bill. You can save it, though, on your home loan. And you're mad if you don't do it. Now, admittedly, if you really hit hard times, getting the refinance might be tricky, but there are a lot of people who are still in a good state and will still get refinanced, and the banks are chasing business. So, get out there and do it.
Steve, as always, I appreciate your time today and your insights. And, we can't make the message plainer. If you want to save some money, go refinance your mortgage.
Absolutely.
Thank you very much. Talk to you again soon.
Thanks, Martin. Cheers.
Cheers.